Hello guys, and welcome to the White Rabbit Trading Channel. As we have a new monthly close and a fresh monthly open, let's take some time to dive into the new monthly statistics and explore what they might mean for the market over the coming weeks and months. First, let's quickly recap the previous outlook and why I had that specific expectation. I was expecting higher prices even in the event of a pullback or a shallow retracement. My focus at that time was squarely on local levels, zones where I could find potential entries if price needed to shake out some liquidity. I was assuming that any retracement would be fairly shallow, simply gathering strength for the next leg higher. That scenario indeed played out exceptionally well. Price consistently formed higher lows on multiple time frames, and that upward momentum eventually carried us to a new all-time high, with the monthly candle closing around 105K. The fact that price held those local support areas and never really dipped into deeper zones was a clear sign that bulls were controlling the market. So our basic hypothesis: price might pull back a little, but ultimately it will continue to make higher highs and higher lows, proved correct. Now, this new monthly close presents us with a very important piece of data. Price formed a clear monthly higher low. That monthly higher low has now become a key structural point on the monthly time frame. As long as price closes above that level, we can view it as a valid, intact higher low structure. In other words, bears would have to force price below that monthly higher low to break the bullish structure at that higher time frame. If price manages to drop but reclaim on wick base or hold above that level, then bulls remain firmly in control on the monthly view. Of course, if we do see a decisive close below that monthly higher low level, it would signal a bearish break of monthly structure. That level is also aligned with a weekly swing low, which further reinforces its importance. If price revisits it and holds, it will likely act as strong demand again, but if that weekly swing low is lost, then it would be a major signal that monthly structure is failing. In short, that level is critical. As long as price stays above it, bulls maintain control. If it breaks, bears gain the upper hand. So, now that we understand why that monthly higher low level is so important, let's take a close look at the actual monthly statistics themselves. Historically, the month of June has shown a bullish close rate of 60%, meaning that in 60% of the last occurrences, the monthly candle for June has closed higher than it opened, while in 40% of cases, it has closed lower. That tells us that bulls have a slight edge when it comes to June's monthly performance, but it's far from a guaranteed outcome. When June does close in the green, the average gain has historically been around 16%, with a median gain of about 15%. That level of statistical expectation would bring Bitcoin roughly into the 120K, 122K range, assuming the cycle were to repeat those historical patterns. On the flip side, when June closes in the red, the average loss is on the order of 15%, and the median loss is about 11%. That would put BTC back down into roughly the 88K, 93K area if a bearish close materializes. Naturally, we don't know in advance whether we will close bullish or bearish, but knowing these historical statistics helps us mentally prepare for both scenarios and size our risk accordingly. Next, let's talk about wicks. The wick of a monthly candle measures how far price extended beyond its open/close range during the month. A bullish wick is how far price dipped lower before reversing up and closing higher, and a bearish wick is how far price spiked higher before reversing down and closing lower. On average, in months that close bullish, the wick to the downside is around 8 to 9%. In other words, even in a bullish month, price often dips 8 to 9% below its open before recovering to close above. If we apply that average to our current price, a typical bullish wick in June would mean price potentially dropping into the mid-90K range, around 95K, 96K, before reversing higher toward the monthly close. Similarly, for bearish wicks in months that end down, the average wiggle to the upside before reversal is about 6 to 7%. That suggests that if June were to close bearish, price might spike up into the 111K, 112K range before reversing lower to close the month red. I have marked out on my chart the zone that would indicate a bearish close, closing below last month's low and back under the previous monthly breaker. That zone, if validated, would likely act as fresh resistance, because it marks the area where price failed to hold during a soured monthly structure. Now, let's consider the two main scenarios, bullish and bearish, and a third option in which price simply churns sideways inside a range. Scenario 1, bullish monthly close. If we do manage to close the month in the green, remember that we will likely first see a wick down to the 95K, 96K area, which would represent that 8 to 9% average dip. If price finds support at our key monthly higher-low level, which is also the monthly breaker zone, and bounces, then bulls can resume their march higher. In that scenario, you could look for a dip into that zone, especially if we see a retest of the monthly higher-low and it holds, as an opportunity. After that bounce, if price rallies and closes strongly above the monthly higher-low zone, we would likely see continuation toward the 120K, 122K area, aligning with the historical average and median bullish gains. That would target that approximate zone as a first big bullish objective. Scenario 2, bearish monthly close. If, instead, price fails to hold the previous monthly level and closes below it, then June would be bearish. The average loss in a bearish June is around 15%, which would target the low 90K region, somewhere between 88K and 93K, if the pattern repeats. In that case, price would likely break below our key monthly breaker, and that could trigger a shift in monthly intrastructure to bearish. Bears would then target the next major support zones, potentially down near 88K or even lower if they keep pressing. The wick up into 111K, 112K before reversal would be a good place for bearish traps, so if you saw price spike to that zone and fail, that would probably be a good place for bears to add on or for bulls to take profits. In short, a bearish close would likely involve a swift squeeze up to the 111K, 112K area, followed by a drop below. Scenario 3, a range-bound month. The third possibility is that price simply stays inside a range, neither breaking fully to the upside nor the downside by the monthly close. In that case, you might see a dip below last month's high, but not a decisive break, so price remains in the upper part of the existing range. For example, we could see price drop into the mid-100Ks, bounce back toward the all-time high, but fail to break, and then drift lower again to close near that 100K, 105K band. Alternatively, we could see price first poke up near the average wick or the median or average based on closes, fail to close that ADH, and then swing down until the monthly close near. Either way, price would remain constrained to that range. If that happens, it simply means we keep chopping between roughly 105K and 95K until the next open. Now, let's switch our focus to lower time frames to refine our strategy and add more detail to our plan. When looking at the yearly time price chart, we also see that the bearish median and bullish wick zones are in the same general support region. That is vital confluence, meaning that if price revisits that spot, it is supported not just by monthly and weekly levels, but also by annual statistical confluence zones. On top of that, we have a monthly breaker in that region with substantial volume, as evidenced by the fixed range volume profile. Volume clusters on volume profiles tell you where big players have transacted, and that zone often becomes a magnet for future price action. Additionally, there's a parabolic trend line extending from the bull market bottom that runs right through that area, and a few anchored VWAPs, volume-weighted average prices, are also intersecting there. That makes the zone incredibly dense with confluence from a monthly swing low to weekly structure, to annual volume clusters, to parabolic and VWAP support. All of that suggests a very high probability area for a major weekly or monthly higher low to form unless, of course, price decisively breaks below that zone, which would invalidate bullish structure on multiple time frames at once. If price does break below that broad confluence zone, we must watch the 74K pivot carefully. Losing 74K would be extremely bearish on the monthly time frame, as it would represent a break of a significant structural pivot. But as long as that pivot holds, bulls remain intact. That, combined with our other confluence factors, makes that zone perhaps the single most important area to watch on the next drop and on the high time frame. However, on shallow pullbacks it can form a higher low above this levels. Next is timing. Historically, the average high or low of the month forms around day 12. In months that eventually close bullish, the statistical average low occurs around day 11, and the subsequent peak, meaning the new high or the close, usually forms around days 16 to 17. Conversely, in months that end up closing bearish, monthly highs often form around day 9, with monthly averages following around days 12 to 14. Translating that into a practical time window, if we see a drop into that confluence zone between days 9 and 12, that could be setting up our monthly low. Of course, these are averages, not guarantees. But knowing that window helps us time our entries. If price drifts into our key support zone on or around the time window, and structure is confirming, then it would be a logical spot to look for a long setup. If instead price rallies into the time toward that 120K, 122K zone, be ready for potential profit taking or a short entry if bearish structure emerges. Aligning price with time statistical windows is a powerful way to boost your edge. We also need to consider FOMC statistics. Because historically, Bitcoin often shows a reversal either 5 bars before the FOMC announcement or right on the FOMC date itself. Since we're on a 2-day chart, 5 bars before the next FOMC falls around June 8th to 9th, and then the announcement itself is usually around June 18th to 19th. That gives us a roughly 10-day window, June 8th to June 18th, where key reversals frequently occur. Conveniently, that aligns almost perfectly with our monthly statistical window, days 9 to 12 for a monthly low, days 16 to 17 for a monthly high. That means if price is near our monthly higher-low zone between June 8th and June 18th, and we see early signs of support or bullish structure, that could line up nicely with both the FOMC reversal window and the monthly statistical average low window. Or, if price is near 120K, 122K or the wick areas, you might see a reversal around the FOMC event, giving you a potential short or fade. That kind of dual alignment price and time is extremely high probability, so I'll be watching that window closely. Now, let's shift our focus to local structure on the daily and 4H charts to refine our precise trade levels. At this moment, Bitcoin is sitting at the 5-day order block. That same zone is also where today's average loss level live. Remember, average loss levels are calculated from historical daily closes, and they often represent zones of elevated liquidity. As long as price holds above this combined 5-day OB and average loss level, you can view it as a valid support area. If we break below and close under it, it becomes a bearish signal on the 5-day and daily time frame, and you should expect a rejection. But if price simply touches or wicks this zone and bounces without a clean close below, that confirms its continued validity as support. Daily structure currently remains intact, with the daily key level just beneath where price sits. That key level is the low of the 5-day order block, which carries unfilled buy orders and liquidity. If price sneaks under that level for a close, it could trigger more selling pressure, but if it holds, we may see a daily snapback type of reaction. Even if the daily breaks, price can still form a weekly higher low if the weekly structure remains unbroken, so keep an open mind and watch for confluence between daily and weekly signals. The last thing you want to do is get trapped in a trade because you assume daily structure must hold, or sometimes, weekly bulls flip daily bears right away. On the 4-hour time frame, structure already broke to the downside, and since then price has been grinding down to the next support zones. That 5-day OB is one of those zones. Beneath that is the daily swing low, which might form an SFP, swing failure pattern, before a bounce can occur. If you want to play a possible bounce from that daily swing low, you'd ideally see a quick 4H wick down, something that sweeps liquidity below swing lows, followed by a strong 4H close back above that level. That would signal that 4H demand is stepping in and gives you a precise entry for a bounce trade. For a stronger move up, price needs to reclaim the 108K, 109K region on the 4H. Best case scenario is a daily close above Tuesday's rejection level, which was around 109K. If we see a 4H close above 109K, that would signal a potential 4H higher low structure and set us up for the next leg higher. That next leg could take us toward the monthly average wicks or 120K if structures remain bullish. Conversely, if 109K fails as resistance, meaning price cannot hold above it and rolls over, it could form a 4H lower high there and open the door for a new leg down. That new leg down could target the weekend swing lows, which are quite poor structurally and likely to be swept first. It's interesting to note that a Saturday candle formed the weekly low. Typically, Saturday moves are so thin that they don't often become weekly pivots. The fact that Saturday did form a weekly low implies that liquidity was being hunted during times with extremely low volume. That's a hint that market makers and large players were aggressively seeking liquidity even on weekend, which is rather unusual. This abnormal Q2 liquidity hunt suggests that if price moves down to sweep those weekend lows again, you should be prepared for a swift reaction, because those weekend low zones might be hunted and can form a daily or weekly high or low. If we do drop below those weekend lows, that could provide entries. That, in a nutshell, is the full picture from monthly statistics down to local structure. If anything materially changes, say monthly structure breaks, I'll share those updates in the Discord channel immediately. The key is to watch for reactions and look for alignment in price, time, and structure before placing any random trades. If you trade without waiting for those confirmations, you run the risk of getting trapped in a false breakout or breakdown. Before I wrap up, one final note: I plan to launch a Patreon soon. On Patreon, I will go much deeper into market structure, talking through how I identify order blocks, how I interpret liquidity, and how I do the stats. If any of you want to dive even deeper, we'll have a place to do so on Patreon with detailed charts, educational videos. I'll keep you posted on launch dates and membership tiers in the near future. Until then, that's all for this monthly update. Thank you for tuning in and taking the time to go through the statistics and structure with me. Remember to stay safe, stay sharp, and stay disciplined. For every push higher, there is a pullback, so keep your plan, your risk, and your time alignment top of mind. I'll see you in the next update. Take care, and happy trading.